Welcome back to the channel. Today we're unpacking one of the biggest financial stories of 2025. It's been reported that China has just offloaded a staggering $23 billion worth of US dollars and Treasury bonds. China has taken bold steps to accelerate its de-dollarization campaign, offloading billions in US dollar reserves and Treasury securities. Under Xi Jinping's leadership, Beijing has mounted a robust counteroffensive to Trump's tariffs by imposing equivalent duties on American imports. We'll dive into what de-dollarization really means, trace the history of China's dollar holdings, explore the geopolitical and economic drivers behind this move, and lay out what it means for global markets and for your investments. Before we jump in, hit the like button. Let's get 1,000 likes on this one. Share the video, and leave your thoughts in the comments. Don't forget to subscribe so you don't miss out on the next important financial investing update. Let's start with the basics. De-dollarization is simply the process by which countries reduce their reliance on the US dollar for trade settlements, foreign exchange reserves and debt financing. Since the end of World War II, the dollar has reigned supreme. It's the world's primary reserve currency, the most liquid funding instrument, and the main invoicing unit for commodities like oil and metals. That dominance has given the United States enormous economic and geopolitical clout. But over the last decade, a growing chorus of nations, from Russia to Iran to China, have quietly been diversifying away from the greenback. China's recent sale of $22.7 billion in US dollars in treasuries marks the largest single monthly drop in years. To put that into context, back in late 2013, China's total holdings of US debt peaked at about $1.35 trillion. Fast forward to the end of 2024, and those holdings had tumbled to around $780 billion, a decline of more than 40% over 11 years. The latest $23 billion sale accelerates that trend and takes China's stash to its lowest point since 2009. Why is China moving so decisively now? Part of the answer lies in escalating tariff tensions. Last month, Beijing raised its retaliatory duties on a broad swath of American imports, everything from semiconductors to soybeans, taking average rates from around 84% up to 125% in some categories. By making dollar-denominated trade more expensive, China is effectively penalizing U.S. businesses and signaling that it's prepared to use economic levers to shift global commerce onto alternative rails. But tariffs are only one piece of the puzzle. China's leaders have long worried about the weaponization of the dollar, the ability of the U.S. to freeze assets, impose sanctions, or restrict dollar-clearing access at, just a moment's notice. From the sanctions on Russia after the Ukraine invasion to the blacklisting of Chinese tech firms, Beijing sees holding large piles of dollars in treasuries as a potential vulnerability. By trimming those holdings, they aim to insulate their foreign reserves from sudden policy shocks. This de-dollarization push is not unique to China. Central banks in Asia, Latin America, and the Middle East have all been quietly reducing dollar allocations while boosting euros, yen, and gold. Over the past 2 years, global official gold reserves have climbed by more than 10%, reaching levels not seen since the mid-1960s. Meanwhile, the euro's share of global reserves has ticked up from about 20% to 22%, and the yuan, while still a small slice at roughly 3%, has been steadily rising as China pushes for greater international use of its currency, including through its digital yuan pilot programs. Here's an interesting detail. China has also been expanding bilateral currency swap lines with major trading partners: Brazil, Russia, South Africa, even parts of Southeast Asia. These swap arrangements allow two central banks to exchange local currencies at a set rate, bypassing the dollar entirely when settling trade. In 2024 alone, China signed new swap agreements totaling over $100 billion in local currency capacity, laying the groundwork for more yuan-settled commerce. So, what does all this mean for investors? Well, first, if you hold long-dated U.S. treasuries, you need to be aware that sustained selling by China and other major holders could push yields higher. Rising yields would put downward pressure on bond prices, and honestly, that could ripple into mortgage rates, corporate borrowing costs, and even equity valuations, especially for high-growth tech names that are really sensitive to discount rates. Second, it's a reminder to diversify, and that doesn't just mean holding different stocks, it means considering exposure to non-dollar assets. European corporate bond ETFs, Japanese government bond funds, and even selective emerging market debt can provide ballast if the dollar's dominance starts to wane. And let's not forget gold bullion prices have already climbed more than 15% over the past year. as central banks and private investors alike look for a safe haven outside the traditional banking system. Third, keep an eye on the U.S. Treasury's monthly report on foreign holdings. These data drops, which are typically released around the end of each month, can honestly be real market movers. A surprise decline in foreign demand for treasuries could send yields soaring and equities tumbling. Likewise, any signs of renewed buying, say from Japan or Europe, could provide a counterbalance. Quick question for you, which currency or asset do you think will be the next serious challenger to the US dollar's hegemony? Will it be the euro, the yuan, gold, or something entirely different like a digital currency? Drop your pick in the comments. I'm excited to see your thoughts. Looking ahead, keep an eye on the upcoming BRICS summit later this year. There's buzz that China and its partners might announce plans for a new payments network, or even a shared settlement currency for intra-BRICS trade. If that happens, it could turbocharge de-dollarization, especially among emerging markets that are already eager to diversify. Of course, it's important to recognize that the dollar's position isn't under imminent threat. It still accounts for over 50% of global reserves and nearly 90% of forex trading. Deep liquidity, established legal frameworks, and the network effects of existing dollar-based systems mean any transition will be gradual. But history shows that no financial regime lasts forever. Just look at the British pound in the 20th century. There are risks on both sides. If global demand for dollars falls too fast, we could see abrupt tightening of U.S. financial conditions, yields spike, credit spreads widen, and emerging markets that rely on dollar funding could face distress. On the flip side, a rapid move toward alternative currencies or gold could destabilize markets by creating multiple competing reserve assets, each with its own liquidity and political risks. So what should you do? Stay informed. Set up alerts for foreign holdings data and Fed announcements. Consider building a small allocation, say 5 to 10% of your portfolio, to non-dollar fixed income or gold. And don't ignore the opportunities in currency-hedged international equity funds, which can help you tap into global growth without bearing unwanted currency risk. Remember, de-dollarization is a marathon, not a sprint. The world's financial architecture will evolve over years, not weeks. But as investors, we need to be proactive, anticipating shifts and positioning ourselves ahead of the curve. Whether that means tilting toward gold miners, adding a euro-denominated bond fund, or simply keeping more dry powder in case yields jump, the time to plan is now. That wraps up our deep dive into China's $23 billion dump and the accelerating trend of de-dollarization. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. If you found value in this video, hit the like button, share your thoughts in the comments, and subscribe for more high-impact financial updates. Thanks for watching, and I'll see you in the next one.